We're jumping straight into SharpLink today. Everyone is watching the price action, but the real story is the strategic pivot to an institutional-grade Ethereum treasury.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And if you're looking to stay ahead of the curve, make sure you hit that subscribe button and smash the like. It really helps us get this out to more people who are trying to navigate these markets alongside you.
Makes a big difference.
It really does. So today we are tackling a story that is, honestly, a bit of a mind bender. We're looking at a company that is effectively undergoing a total corporate identity transplant.
Yeah, that's a good way to put it.
We're talking about a firm that used to be a sports betting affiliate, literally just marketing gambling sites, trying to drive traffic, and they've decided to just burn the boats and become a proxy for Ethereum.
It is a radical shift. And usually, when you see a pivot this aggressive in the public markets, it smells like desperation.
Right, like the classic, our old business is dying, let's just jump on whatever the newest bandwagon maneuver.
Exactly. But when you actually pop the hood on SharpLink and you look at the mechanics of what they're actually building, it's not just a bandwagon play.
It's not just slapping crypto on the nameplate.
No, not at all. It's a highly sophisticated financial engineering strategy.
And that's exactly what we need to unpack today. Because on the surface, it sounds crazy. We used to do sports betting, now we just hold crypto.
Right.
But the market is reacting. The smart money, we're seeing aggressive call options being bought. So let's start with the bull case.
Let's do it.
Why make this shift? Why abandon a business model that, can actually be pretty lucrative?
Well, affiliate marketing in sports betting is lucrative for some, but it's a massive grind.
Heavy competition.
Unbelievably heavy. High volume, low margin, and you're just constantly fighting for traffic against giants. The pivot to becoming a NASDAQ-listed Ethereum treasury platform that is a move from an operating business to an asset business.
So instead of having to sweat for every single dollar, they just want their dollars to work for them.
Precisely. The core thesis here isn't just that they like Ethereum, it's that the current market structure for accessing Ethereum is structurally flawed.
Okay, that's interesting.
They're trying to solve a problem that the giant ETFs, I'm talking the BlackRocks and Fidelities of the world, actually cannot solve right now.
Okay, wait. That is a massive claim. The spot ETFs are huge. They have billions in assets under management. They're super liquid. They're incredibly easy for anyone with a brokerage account to buy. What can a small cap company possibly do that Wall Street giants can't?
It all comes down to one word.
Yield.
Yield. This is the real aha moment of the whole situation. If you buy a spot Ethereum ETF right now, you are getting pure exposure to the price of the asset.
If the price goes up 10%, my ETF goes up 10%.
Minus their management fees, yes. But Ethereum isn't just a digital rock. It's not like Bitcoin where it just sits there. It's a yield-bearing asset. You can stake it to secure the network, and in return, you earn rewards.
Right, so it's closer to a bond or a dividend-paying stock in that specific sense. There's a native return just for holding it and participating.
Exactly. But here is the catch. The spot ETFs are completely hamstrung by SEC liquidity rules and their own trust structures. Most of them are legally prevented from staking the Ethereum they hold.
Wow.
Or, if they are allowed in some capacity, they might be capped at something like 50% utilization to ensure daily liquidity. They are built to perfectly track the spot price, not to optimize the underlying asset.
So if I hold the ETF, I'm essentially leaving money on the table.
You absolutely are.
It's like buying a rental property in a great neighborhood, letting it sit totally empty and just hoping the property value goes up over time, while completely ignoring the fact that I could be collecting rent checks every single month.
That is the perfect analogy. And in the crypto world, that rent-the-staking yield is not negligible. Right. You're talking about 3 to 4% annually paid out in more Ethereum.
Which then compounds.
Exactly. SharpLink's entire model is built around the idea that they, as an operating company, are not bound by those same restrictions as an ETF trust. They are aiming to stake 100% of their holdings.
Okay, so they capture the yield. But here's the skepticism I usually have with these types of setups. Usually the company takes a massive cut for doing the work.
Right.
If I stake my crypto on a major exchange, they take a fat fee. If I use a liquid staking service, they take a fee. What's SharpLink's angle? Are they just another middleman?
This is what makes it fascinating. This is what we call their yield moat. Unlike some of those exchange models that might skim off up to 35% of your staking rewards just calling it a management fee, SharpLink is designed to pass that value back to the shareholder.
How so?
The yield goes directly onto their balance sheet. It increases the overall book value of the company itself.
So they aren't just skimming off the top to pay executive bonuses. They are using the yield to make the company itself fatter?
Correct. So theoretically, holding a share of SharpLink should actually outperform holding raw Ethereum over a long enough time horizon.
Because you are getting the price appreciation of the asset, plus the compounding effect of that staking yield that the ETFs can't give you.
You nailed it.
That's a very compelling argument for the product itself. But we have to talk about execution, because saying, hey, we are going to stick everything and actually doing it without getting hacked or losing the private keys, that's a completely different story.
It is. Security is everything here.
The research notes mention this term, operational alpha. Is that just corporate buzzword soup, or does it actually mean something tangible?
It definitely sounds like buzzword soup, I'll grant you that. But in this specific context, it refers to the actual sophistication of their treasury management. They aren't just logging into a retail Coinbase account and clicking the stake button.
I would hope not.
They are utilizing institutional in-house custody solutions and participating in complex DeFi, decentralized finance strategies to optimize that yield. And they actually have a live dashboard for their holdings and rewards, which adds a layer of transparency. But really, this is where the brain trust comes in.
The leadership.
Exactly.
No.
If this was just the old sports betting executive team trying to figure out how crypto wallets work, I'd be terrified.
Right. Like, hey guys, I just watched a YouTube tutorial on how to use MetaMask. Trust me, with the entire corporate treasury, that's a literal nightmare scenario for an investor.
A total nightmare. But look at who is actually driving this ship now. You have Joseph Chellam involved.
Okay, for those who don't know, give us the resume. Why does that name matter?
He is the former digital asset chief at BlackRock.
Oh, wow.
Yeah. You really do not get more institutional DNA than BlackRock. He deeply understands regulatory frameworks. He understands enterprise-grade custody. And crucially, he understands exactly how Wall Street views these types of assets.
That is a very serious stamp of approval for a small company. And he's not acting alone here, right?
No, not at all. You also have the direct involvement of Joseph Lubin.
The co-founder of Ethereum.
The very same. Through partnerships with Consensus. So just think about that combination for a second. You have the guy who literally helped build the Ethereum network and the guy who helped the biggest asset manager in the world figure out how to trade it.
Both advising on this specific treasury strategy.
Yes. That tells you this isn't just a whim.
Yeah.
This is a highly calculated infrastructure play.
It definitely adds a layer of credibility that you just don't typically see in these small cap pivots. It feels like the adults are actually in the room.
For sure.
But I want to get to the financial mechanics of this, because there is a term floating around this story that I think confuses a lot of people. Accretive issuance.
Ah, yes. This is the engine of the entire strategy.
Let's break this down really simply, because normally when a company issues new stock, when they sell more shares to the public, it's bad for existing shareholders.
It's dilution.
Exactly. My slice of the pizza gets smaller. So why is SharpLink telling the market that issuing more shares is a good thing?
It is only a good thing if the math works perfectly, and the math relies entirely on the stock trading at a premium to the underlying assets. Let's do a very simplified example.
Let's do it.
Imagine SharpLink owns exactly $100 worth of Ethereum for every single share of stock that exists. So the net asset value, the NAV, is $100.
Okay, following you so far. One share equals $100 of actual ETH.
But because public market investors are really excited about that yield moat we talked about, or maybe they're just excited about the future potential, the stock is actually trading at $120 on the open market.
Okay, so that's a 20% premium. The stock is expensive relative to what they actually hold in the vault.
Right. So here's what SharpLink does. They issue a brand new share, and they sell it to the market for that $120 in cash.
Okay, and then they take that cash.
And they immediately turn around and buy $120 worth of Ethereum on the open market.
I think I see where this is going.
Before that specific transaction, every share represented $100 of ETH. But that one new share just brought in $120 of ETH to the Treasury.
So if you pull it all together and average it out across all the shares.
The amount of Ethereum per share has actually gone up for everybody.
Wow. So even though there are technically more shares in existence, even though my percentage ownership of the total company is diluted, the actual fundamental value of the assets backing my specific share has increased.
Precisely. They are using the overvaluation of their own stock to arbitrage the market. They acquire more assets than they could ever afford with just their traditional cash flow. It is the exact playbook that was popularized with Bitcoin treasuries.
Like MicroStrategy.
Exactly like them. They turn their public stock into a currency that is momentarily more valuable than cash, and they use it to aggressively hoard the underlying asset. But SharpLink is doing it specifically for Ethereum, with the added benefit of that staking yield.
It almost sounds like a cheat code when you explain it like that. But
Well-
and this is a bit, but it relies entirely on the market being willing to continue paying that premium.
That is the absolute linchpin.
Yep.
If the stock ever trades flat to the value of Ethereum, or worse, if it trades at a discount,
The machine breaks.
the machine completely breaks.
Right.
You cannot do accretive issuance if your stock is undervalued. It becomes destructive issuance. The whole flywheel stops spinning.
And that is a perfect transition to the bear case, because we've painted this really rosy picture of infinite money glitches and Wall Street geniuses.
Yep.
But we have to look at the cold, hard reality of where the company actually is today.
I do.
And I'll lead the charge on this one, because when I look at the recent financial reporting, yikes.
It is genuinely ugly. There is no sugarcoating the historical numbers. The legacy earnings per share, the EPS, sits at negative 41.28.
Negative $41 per share.
Yes.
That is a staggering hole to be in.
It's a crater. Now, we do have to contextualize why it's that bad. It heavily reflects the one-time costs of this massive transition.
Right, unwinding the old business.
Exactly. They are completely shutting down the legacy sports betting operations. That means paying severance, legally breaking contracts, writing down old assets, while simultaneously spending a fortune building this new high-tech, institutional-grade treasury infrastructure.
So on paper, they are just hemorrhaging cash. They are burning the old furniture to keep the house warm while they try to build the new extension.
Essentially, yes. Now, to their credit, their debt to equity is very clean. It's essentially listed as NA because they aren't loaded up with traditional bank loans. That's a huge lifeline. But they are strictly in a prove-it phase.
Because they have no traditional revenue stream to fall back on if this crypto strategy stalls out.
None. They are flying without a parachute. If the main engine fails, they crash. And the engine here is exclusively the macro price of Ethereum.
Which brings us to what we call the volatility trap. We have to be brutally honest about the asset class we are dealing with here. SharpLink is a high beta asset,
Extremely high beta.
meaning it moves much faster and much harder than the broader market.
Exactly. The old saying in crypto is, if Bitcoin sneezes, Ethereum catches a cold.
Right. And if Ethereum catches a cold,
SharpLink gets pneumonia. If the price of Ethereum drops 20% in a week, which it absolutely can do, SharpLink's balance sheet takes a direct, immediate, unhedged hit. They are completely at the mercy of macro crypto trends.
so if we enter another one of those brutal crypto winters, if prices just flatline or bleed out for 2 years, SharpLink is suddenly just a company with a high operational burn rate holding an asset that isn't appreciating.
Correct. And Wall Street is watching this execution risk very closely. We saw a recent move by the analyst firm B. Riley. They have been covering the stock for a while.
Right. And they slashed their price target pretty dramatically. It went from $19 all the way down to $10.
That is nearly a 50% haircut on expectations. It is very significant. But here is the nuance, and you really have to read between the lines on these analyst notes, and they maintained their positive outlook.
So they didn't downgrade them to a negative rating. They kept their upbeat stance.
Exactly. It signals that Wall Street still sees the long-term potential. The fundamental thesis of the yield-generating treasury is still intact for them, but they are radically tempering their near-term expectations.
Right. They're injecting a dose of reality.
Yes. They are actively pricing in the risks of the transition and the current market volatility. They are basically saying to investors, look, we still see a path to $10, which is still upside from where it's currently trading, but $19 was just a fantasy in this current macro climate.
It's a reality check. And then there is the execution risk regarding that premium we just spent so much time talking about, because they aren't the only game in town.
Far from it. They are competing directly with those massive spot ETFs we mentioned, and frankly, other potential crypto treasuries that might pop up and try to copy this exact model. Investors are only paying a premium for SharpLink stock over the raw price of Ethereum because they expect that yield strategy to be executed flawlessly.
Right. If I just wanted plain Ethereum, I'd just go buy Ethereum. I'm buying SharpLink because I believe they can generate more value over time than I can on my own.
And if they fail to execute, if the yield doesn't materialize the way they project, or if the SEC steps in and says, hey, no staking for public companies either, or if the accretive issuance math fails, that premium could evaporate overnight.
And the stock could actually start trading at a discount to its holdings.
Which is the ultimate nightmare scenario for a treasury company.
So the stakes are incredibly high. It's basically a high wire act without a net.
That is a perfect description.
Okay, so we have laid out the bull case. We have laid out the bear case. Now, for you listening who is thinking, okay, I'm intrigued. This sounds like a wild ride. What do we actually need to watch? Because timing is absolutely everything in a trade setup like this.
The calendar is your best friend right now. We have an earnings date estimated for March 16th, 2026.
March 16th, circle it. But when that report actually drops, I feel like looking at standard top-line revenue is going to be incredibly misleading.
It will be worse than misleading. It will be completely useless.
Because the old business is gone.
Right. If you look for revenue from selling affiliate services, you are going to be severely disappointed. You need to look specifically for two brand new metrics: ETH holdings growth and staking yields.
Rest a new scorecard. Are they actually accumulating more Ethereum per share?
That is the only metric that truly matters anymore. If the holdings per share are flat or down, the whole strategy is failing. If they are up, the flywheel is officially spinning. You want to see hard proof on the balance sheet that the operational alpha is real.
And beyond the raw fundamentals, the charts are screaming right now. We have to talk about the technicals and the flow. There is some very, very unusual options activity happening under the surface.
There really is. We are seeing what options traders call bullish call sweeps. Specifically, our research flagged the July 17th $20 calls and the Friday $8 calls.
Okay, let's explain that for the non-trader listening. Why does a sweep matter?
A sweep usually means a very large institutional order is broken up into smaller chunks to get filled as quickly as possible across multiple different exchanges.
So they're trying to hide their size, but they're in a massive hurry.
Exactly. It almost always indicates institutional buying or a very aggressive, highly confident trader. And look at the strike price. They are targeting $20 for July.
The stock is hovering in the 656 to 729 range right now. So someone is betting big, urgent money that the stock is going to roughly triple in the next 5 months.
Yes, that is a deeply out-of-the-money bet. That isn't a conservative hedge. That isn't a standard portfolio allocation. That is purely speculative money betting on a massive violent breakout or a huge volatility spike.
Someone is expecting fireworks.
And looking at the volume relative to open interest just being the total number of existing contracts out there, the volume is spiking hard. That suggests entirely new money is entering the trade, positioning for a major move.
It's extremely bullish positioning. It suggests expectations of a significant move upward, potentially tied to that March 16th earnings release, or maybe a broader market shift. Which brings us to the macro catalysts. We have to talk about sector rotation.
That's the broader tide that lifts all the boats. In standard crypto market cycles, we typically see Bitcoin run first. It gets all the mainstream headlines. It gets the massive ETF inflows. It basically sucks all the oxygen out of the room.
And then, once Bitcoin finally stabilizes and finds a range,
then the capital starts to rotate. Traders take their massive Bitcoin profits, and they start looking out on the risk curve for higher beta plays. They move into Ethereum and the smaller altcoins. If that rotation happens soon, SharpLink acts as a highly leveraged play on that specific rotation.
Because of that high beta nature we talked about earlier, a 10% move upward in Ethereum could easily translate to a 20 or 30% move in SharpLink's stock.
Exactly. It's like adding literal rocket fuel to the fire. If the market pivots its attention to ETH, SharpLink is perfectly positioned to catch that wind in a big, big way. But again, as we warned, leverage cuts both ways.
Always. Okay, let's pull all of this together. We have a company that has completely reinvented itself. It has moved from a dying, low-margin business model to a cutting-edge financial strategy. It has a structural yield advantage over the massive ETFs. It has heavy-hitting institutional leadership with Chilome and Lubin.
Boy.
But it has a terrifying EPS deficit, extremely high execution risk, and is totally 100% dependent on the broader crypto market staying hot.
It is a very complex picture. It is certainly not a set-it-and-forget-it type of stock.
So let's wrap this up with a final thought. If I'm looking at this trade right now, how should I fundamentally frame it?
I think you have to look at this strictly as a swing trade potential leading into that March 16th earnings date. You have the momentum from the aggressive options flow, you have the compelling narrative of the smart money pivot, and you have the macro backdrop of a potential crypto sector rotation.
It feels like a trade for the bold.
It is. This is for the investor who specifically wants Ethereum exposure but wants that yield kicker. The person who looks at a standard ETF and says, that's just too boring, I want more upside. But you have to be able to stomach the wild volatility. This is a company undergoing a massive, painful identity change. It is not a blue-chip dividend stock.
No, it's a venture-style bet taking place in the public markets.
That's exactly what it is.
Yeah.
A venture bet with daily public liquidity. And remember, keep watching those options flows. Those massive sweeps are telling us a story about what the big money expects. Do not ignore them.
The lowdown is simple. SharpLink is trying to do what the Wall Street giants literally can't capture, the native yield. If they pull it off, the upside is significant. If they stumble, it's a very long way down. But with the brain trust they have assembled, it is definitely one to watch.
Absolutely.
But I'll leave you with this one final thought to mull over. We keep talking about them competing with the big ETFs. But what happens if a giant like Fidelity decides it's just cheaper and easier to buy SharpLink outright for their staking infrastructure rather than fighting the SEC to build their own?
That would change everything.
Something to think about. That's it for our analysis of SharpLink. Thanks for tuning in to the Easy Money Show.
Stay curious.
And we'll catch you on the next one. Don't forget to like and subscribe.